Hello, everyone. This is our discussion or narration about the slides having to do with partnerships, chapter 15 in your textbook. Almost to the end here. And just so you understand, in today's world, partnerships or partnerships that we talk about in this chapter are almost all what are referred to as LLC organizations. That's the state law that governs them. This is the federal tax issues having to do with those. So the term partnerships has really become very rare. A true general partnership, most of them have become LLCs. Now the IRS generally looks at the LLCs as general partnerships, except in a couple of pretty specific ways. So these will still apply, these principles, but they apply to a little differently than what you might think from their discussion here. So we're going to look at these slides. First of all, define it. Basically, very loosely defined, it could be any kind of association for profit. There's more than one. Can have any of these as partners. Makes you a very flexible entity, including even an LLC. Okay, first of all, we'll talk about tax year. You have to match your tax year with your majority partner as a first rule. So if you have corporation A and B, and A owns 60%, and they have a March 31st year end, then the partnership between A and B must use a March 31st year end. Second, if there's no majority, that clear-cut majority, maybe you have three partners that have 33% each or 50-50 or something, then you have to match it with all your principal partners. So you're only going to consider those that have more than 5%. So in this case, A and B each own 50%. They both have the same tax year. So the year end for the partnership, pretty straightforward. June 30th matches all of those principal partners. But what if that doesn't work? Okay, if all principal partners don't have the same tax year, least aggregate deferral method, meaning the least amount of time lag between when the partnership would report income and when the partners would report income. Okay, so there's exceptions if you have a natural business year. So you have a ski resort or something like that where you have a very seasonal business and much of the business is in 1 or 2 months period. If that's the case, for 25% or more, you can use the natural business year if that happens in 3 consecutive years. But that can't happen until you've been in business 3 years, right? So you can't set up a new partnership and have this apply. It would have to be something you go back and change after you've been in business for a little while. All right? And you can select tax years 3 months deferral for its partners. So if the partnership is 12/31, it can if required, you can select 9/30, 10/31, or 11/30. Because you see, there's no more than 3 months between the time when the partnership ends and when you would have reported it to the partners. If you want to change once from the required, if you're using the required year, you don't have to get permission. But if you're changing to a non-required year, from a required year to a non-required year because of the natural year or something like that, then you have to get permission. So, how does a partnership work? It's not a taxable entity. All of the income and expenses pass through the individual partners. So, all of them that are treated the same. Regular business income is ordinary income. So the issue with partnerships is the differentiating between business or ordinary income and what we call separately stated items. So here's how you do the partnership ordinary income. This is the things you used to seeing, gains and losses from regular business assets, that sort of thing, ordinary expenses, guaranteed payments, that's to two partners. Guaranteed payments are like salaries, but you don't have to do withholding and other things to the partners, usually in return for a set amount of services or some type of commitment of time, so that it evens out. So you could give one partner who spends more time a higher guaranteed payment than another partner who doesn't spend as much time. That sort of thing. That's what guaranteed payments are. Those are part and subtracted out to get ordinary or business income. Now, other items of expense and credit may be treated differently by the various partners. So each partner needs to have, remember, each partner gets a percentage of the total. And those special items need to be separately stated. Here's some things, and these look somewhat familiar. We have dealt with these ideas before, most of them. We've talked about interest income, we've talked about rental income, we've talked about long-term versus short-term capital gains and losses, that sort of thing. Those all need to be separately stated, including guaranteed payments. Although they're subtracted for ordinary income, they are on a separate line so that they're very clear to the IRS for reporting purposes. Tax-exempt income, all these things could have different treatment for each partner. So that's why they have to be separately stated. Meaning one partner could get more of a benefit than the other, or based on their tax bracket or that sort of thing. That's why these are separately stated. So we use a 1065 to report ordinary income and separately stated. And the partnership tax return is set up so that you can see first the ordinary income and then the separately stated items. And the 1065 is due 2.5 months after the close of the partnership tax year. So March 15th using calendar year. Get it extend for 6 months by using form 7004. All right. Like anything you need, any other asset, you have a partnership interest basis. You have your basis as a partner in your partnership interest. And so if you sell it, you're going to calculate gain or loss based on how much you sell it for compared to your basis. It also determines how much losses you can utilize from the partnership. Meaning if business loses money, how much of that loss can be deductible? You can only deduct up to the amount of your basis. So we need to know what our basis is so that we know how much we can deduct if there's in the case of a loss. All right, the partnership basis goes up and down based on the things listed here. Okay, contribution make it go up, right? And then we exchange cash or other property for the partnership interest. The adjusted basis in the property becomes the adjusted basis to the partnership and becomes the partner's becomes their basis in the partnership's share or partnership interest. You do not recognize gain or loss on contribution of property to a partnership in return for partnership interest, regardless of what percentage you own after. So there's no requirement like there was with a corporation to own 80% afterwards. Any exchange and contribution is tax-free between a partner and a partnership. The only way that it would ever be taxed on that is if you actually got cash back on top of the amount of the partnership interest. Okay, so once you have that original basis, it goes up with income and separately stated items, down with losses, and down with any separately stated items. Regardless of whether those items are deductible or not, they change basis. Okay, so where do these items come from? First of all, this, whoops, this is a part of your 1065. So this is what a 1065 looks like. And notice the first page, page 1, is basically your ordinary business income. Regular business deductions and things, there's always a place for other deductions and so forth if they aren't listed there. Then you go to Schedule B, which is a bunch of questions about the situation of the partnership. And that goes on for page 2 and 3, whether they own other entities, whether they have foreign operations, all that good stuff, how much assets, that sort of thing. Most of the time, those are no questions, and you just go down and check them all off because it really is only applies to those very specialized partnerships. Then much more important is Schedule K. This is where you have listed your separately stated items. This line 1 is carried over from page 1. And then after this is all the separately stated items. You'll recognize them from our list on the slides earlier. This is the total for the whole partnership. Goes on the K, Schedule K. And then the part that's just for one partner alone goes on the K1. See how it's related? This is Schedule K. Each partner gets a Schedule K1 that divides up this according to their ownership percentage. And then the last page is a reconciliation and place for balance sheets that are required for larger partnerships, those that have substantial assets. All right. So here is your K1, and this has the same pieces as the Schedule K we just looked at, but this is only for the particular partner listed. Okay. And so their percentage, if they're 50% partners, it would be half of what was listed on the Schedule K. Right? We've already talked about this. Can never go below 0. Your basis cannot be 0. If you have a loss that's going to make your basis go below 0, you will have to carry it over until the next year or the following year until basis is restored. And you get more basis. How do you get more basis? You would have income in the following year, or you would have a contribution to the partnership with increased basis. Now, here's the interesting thing about partnerships. Your partner's basis is increased by the share of the partnership liabilities. All right? So that's because as a general partnership, partners are liable for that debt, meaning they have to pay it back. So it's at risk, and that increases our basis. Limited partnerships will not, partners are not liable for the debts, and therefore not going to be able to increase their basis by the amount of the partnership. LLCs usually are going to do so, increase the basis by the amount of the liabilities. So example, A and B are general partners, have 70%, abilities are 30%. AB's basis includes A's basis includes $9,000 of the liabilities plus, and then B's basis includes the other 70%. Distributions make your partnership interest or your basis in a partnership interest go down. No gain or loss on distributions, just like there wasn't on contributions. Even if it's non-cash property, there's no gain or loss. So if you distribute assets to a partner, there's not going to be a gain or loss on that. But you cannot have your partner basis go below 0. If you have any of greater distribution than the amount of their partnership interest, your basis in the partnership interest, then you could have a gain. So here's our partnership interest is $10,000. We distribute $8,000. It's tax-free. reduces basis from 10 down to 2. No tax on that. In this case, partner's basis is $2,000. They distribute $5,000. $2,000 is tax-free. Goes to 0 and recognizes a $3,000 gain. They actually got more distribution than they had basis. Basis of the property received by the partner is the same as when it was in the hands of the partnership, meaning it's carryover basis. If it would reduce the partner's basis below 0, then it becomes your basis in that property is your partnership interest basis. All right. So the partnership's adjusted basis of the property is $4,500. Partnership distributes property worth $8,000. That would make get our tax free to the partner. It reduces our basis from $5,000 down by the $4,500 to $500. Okay, and our basis in the partner's basis in the undistributed property is $4,500, same as the property was in the hands of the partnership. In this case, partnership's adjusted basis is $12,000, but it's on, and their partner's basis is only $3,000. Property worth $8,000. That clearly tax-free, reduces the basis to 0. All right, and the partner's basis in the property distributed is $3,000, same as his partnership interest, because this is actually would make it go below 0, but you can't do that. You always treat cash distributed first, and then any other property if there's distribution of both of them.